Portfolio, asset allocation, and diversification. When an investor puts together his or her portfolio, there's a defined future goal for the money. The time horizon to reach the goal is taken into account. And finally, the amount of risk relative to reward is also considered carefully. Asset allocation is all about allocating your money to different asset classes, and that's finding the right portion of stocks, bonds, and cash. The proper asset allocation is one of the most important factors in the performance of your investment portfolio. You'll choose the stock portion for growth, bonds for steady performance and stability, and the cash position for principal protection. It is often said that asset allocation is responsible for up to 90% of a diversified portfolio's return. Don't put all of your eggs in one basket. I know you've probably heard that one too many times. You can further diversify your assets in each asset class to lower your overall risk. I could diversify my stock holdings by buying large cap stocks, mid cap stocks, and I can also include small cap stocks as well. For additional diversification, I could buy into international stocks. I can diversify my bond portfolio by investing in short, intermediate, and long-term bonds. We'll also include some real estate. And finally, we'll include a cash position for my portfolio. Now, you're spreading your bets across the field instead of concentrating on one particular type of investment. You do potentially lower your upside potential. But what if I bet all of my money on one stock? What if I was wrong? Market leadership changes all of the time. Money goes to where it's treated the best. But bet big on one thing and it could be your undoing. Let's take a look at market leaders from 1996 to 2006 and the best sectors to have had your money invested and the worst as well. From 1996 to 1998, the S&P 500 was the best performing sector. From 1999 to 2001, the small caps were. 2002, bonds were first place. 2003 to 2004, once again, the small cap stocks. Finally, 2005 to 2006, international stocks yielded the best return. Now let's include all the sectors in between. From 1996 to 1998, the S&P was the best place to be. But 2000 to 2006, the S&P was second to last for 7 straight years. Bonds were the best place to be in 2002. But 4 straight years from 2003 to 2006, they were dead last. The point is, invest for performance and spread your bets across the field to lower your downside risk. Now, this is a loose interpretation of the popular Callan chart, which provides a visual basis for making the case for diversification.